Hi guys, it's Chad Larson of MLD Wealth Management Group with Canaccord Genuity. I'm here today joined with Tom Caulfield of Fidelity Investments, the world's largest asset manager. I've introduced him previously on some of our other video series, so I thank him for being here today. So first off, before I get going, I'll address my seemingly vacuum of professionalism as I wear a hat here today. So first off, I'm sporting the Yankees, and friends of mine in New York who've been impacted severely through this crisis. And secondly, a sneak a peek, I did attempt to cut my own hair, which is more of a Britney Spears 2007 style during her mental breakdown. So with that being said, what we're talking about today is we've touched on many topics through this time in delivering content to you guys while everyone's at home during COVID, is in and around currency and in and around gold. Some questions are coming up on an outlook for what the world looks like post bazooka-like quantitative easing and helicopter money, and how that will play into portfolios and the inclusion of gold. As many of you know or don't know, we've had a heavy weighting to gold bullion, which is positive year to date and has really helped dampen a lot of the severity of the crash of the equity markets and creating both opportunities. So we'll discuss in a little bit later after Tom shares his thoughts about what these various different asset classes do and how currency management through active management can significantly add alpha and reduce volatility in portfolios. So, with that, Tom, thanks for being here. And I'd love some of your thoughts in and around, CAD to US dollar and in and around gold and its inclusion in a portfolio. And by the way, so everyone knows, this is the third time we're recording this because we've had technical issues. So hopefully it goes off without a hitch. Thanks, Tom.
Thank you so much, Chad, and congratulations to you and your team for taking the leadership to put these webcasts together. I know your audience is going to enjoy these in the days to come. Let's kick it off with a look at the Canadian dollar. It's trading at $1.40 to USD or a 71-cent C dollar. As a petrodollar, we are tied to the price of oil and the price of copper. Moving to the larger discussion on the US dollar, this will provide really the bulk of the discussion. The US dollar is still widely viewed as the world currency, and there is a strong belief that the US will continue to be a world leader geopolitically, friendly business environment, rule of law, democracy, etc. As you'll probably see in the media every so often, there is a flight to USD for safety. I'll give you the example when you're traveling to a foreign country and you run out of the local currency. If you have USD, chances are the local will accept it. That might not be the case if you only have Canadian dollars to exchange. Obviously, there are a lot of nuances, but the US dollar is recognized everywhere, and in particular in global business. So it tends to perform better in the risk-off environment. Bringing it back to the market, generally speaking, when there is a risk-off mode in the market, investors tend to rush to USD or US-denominated securities that you had alluded to, i.e. US Treasuries. So in a risk-off environment, we'll generally see the Canadian dollar depreciate relative to the US dollar, which we have been seeing. This is not to suggest that Canada is a risky country, but rather US is a stronger, larger country relative to Canada. Also here at home, we are mostly still a resources-dependent country with oil and mining. Moreover, that's not to say that as a Canadian investor, you should only hold US dollars in your investments, as we could revisit the 2000s where there was a strong commodities environment. Your equity gains would be impacted by the CAD USD appreciation. Moving to gold, interestingly, all the gold mined to date would fit in about 4 Olympic-sized pools. Usage of gold today is about 50% for jewelry, 20% for the government, 15% for industrial use, and about 15% for investments. So common reasons we would be holding gold are to hedge against inflation, global instability, speculate on demand growth, and for portfolio diversification. US dollars, for instance, are not backed by a commodity like gold. They are a paper currency and are backed by the government. when governments are printing money, this can lead to inflation, and gold can help to hedge this in your portfolio.
Yeah, I'll jump in there quickly. And we were talking about this earlier. I think people need to understand in what our tools are in and around being investors is, we're going to see inflation, we're going to see deflation, we're going to see money printing, we're going to see the debasement of fiat currencies. Like on any given day, we can be whipsawed into being bullish and bearish. I think long term and medium term and short term, those are all very different trades, and we do our best with our active managers and with our tactical overlays to best position through that. And I really caution our investors is that you're never all in or all out, and that the various asset classes that are represented across our client accounts, including with Fidelity's global mandates, is different asset classes are there to do different things, and not all horses pull at the same time. And I've given the analogy, as I like to, I guess, tell parables for a living, but gold, fixed income, cash, non-correlated securities, they act like that as having a goaltender on the ice. And they're there to stop the puck from going in the net. And they're the source largely sometimes for that liquidity for those rebalancing events. So maybe even in the short term, when we discussed 15% of the gold supply being, in the investment bucket of it, we could obviously speculate. And I hate going down these rabbit holes. Jewelry demand will go down. Or, listen, everything's going down right now. Someone called me today and asked me, how auto dealerships are doing, and I said, well, they're not selling any cars, and that's pretty obvious today. But when you do take a step back, and I think we've all determined that the world is not over, how long and for how deep this trench is that we're carving our way out of. I really want to caution our investors and people listening that this is in and around our people, our processes, and the philosophy and the alignment that we've had with Fidelity through their stewardship, through our mandates and guiding us has been paramount. If there's any other comments, or perhaps maybe we did discuss whereby our viewers could find more information on this to go down their own rabbit holes, perhaps you could give some information on that.
That's terrific. And I would certainly encourage Chad for additional information. Would encourage our audience to have a look at www.fidelity.ca. And also, if you're visiting LinkedIn, to have a look at Urian Timmer, who's our head of global macro.
Awesome. I think with that, especially after filming this 3 times, I think we nailed it. I guess it'll all come down to the likes or the clicks that we get. But I want to thank you again so much, and we'll be talking soon. And take care.
Thank you so much, Chad.
Cheers.